Good day. This is the Eye of the Storm podcast with the big picture technical update for the S&P 500 and the NASDAQ 100, and being recorded on Saturday, December the 23rd, 2023. First and foremost, I want to wish everybody again a very Merry Christmas, a very safe holiday, and that hopefully there'll be plenty of family time, enjoyment, and we just get a little bit of a rest from everything that's going on, and that we can just share some good times with family. I'm going to begin with the S&P. And as I have discussed in a few updates this past couple of weeks, is that I've gone back, particularly here in the S&P 500, and I have revised the degree labeling. And basically what I've done is that instead of here, what I've marked as our high that we saw in January of 2022, instead of being a super cycle third wave, I've knocked it down a degree. And I've made it as a cycle degree third wave that was completed. And that cycle degree third wave began in 1949. So, or July of 1949 to be more exact. And previously, I had been labeling it as a supercycle wave three, and that began in April of 1942. So the reason behind that is currently the moves would all be a part of a supercycle fourth wave. So we'd be doing cycle degree ABC. And because we're still within a primary degree, it extends quite a bit out into our future and really would suggest that we're going to have much deeper correction, which now starts to teeter on, is that actually what we're confronting now versus several years out after we've completed an additional cycle degree fifth wave up? So still yet to be seen, to be honest with you. It's like there's so many different things that could really turn this market once again on its heels and produce some very serious downside, as well as there's some things coming up that could, if all works out on a geopolitical front, could continue to really support some strong advancements in particular sectors within our market. So going to what we have, let me just do a quick review. So all the way back in October of 1929, so the data that I have for the SPX for the cash market starts back in 1928, in January of 1928, excuse me. And this is all via Thinkorswim. So that's quite a bit of data. So following what R.N. Elliott in his original works and how he first started to label the Dow and then the S&P is a grand supercycle. So I don't have that label up under my degrees. I will add that. So it's a grand supercycle 1 and 2. And that just encompasses the 1929 high and the 1929 crash, which actually is this right here. And then that was the ABC, but it was the C wave that delivered all the pain and all of the damage to the markets back in 1929. And that low was reached in April of 1932 for grand supercycle wave 2. So within that larger count, we are still within a grand supercycle wave 3, but we don't count quite like that way. So we have grand supercycle 1 and 2, supercycle degree 1 and 2, and that's the one that I've used and referenced several times. That completed in 1942. And then we have cycle 1 and 2. Cycle 2 completed in 1949, or the end of April, May of 1949. And so that's the end of World War II. We started to see the expansion. And then with all the things that happened within our own country economically, and all the different things, and just the growth the sector growth, the corporate growth, the country, everything kind of just moving all together, we have built up a cycle degree third wave. And within that, there's going to be 5 waves of primary degree, which previously now I had been labeling as in the cycle. So even though this internal would have been primary, I had labeled here, I had to pull the third wave up, right? Here's the crash of 87. And I believe I had 3 and 4 there, and this would have been primary 5 and cycle wave 3, and then ABC cycle wave 4. That's how I had it before. But because, I mean, all the labeling, essentially, it's the same move. It's just the degree is different. And I've done that all the way up from counting within here, within the cycle 3. So instead of it ending here, it was primary 3. ABC, primary 4. Great financial collapse of 2008, 2009 right there. But it was all part of a larger ABC. So this A wave in the S&P was the dot-com crash. The dot-com bust, whatever you want to call it, that truly drove the NASDAQ down 87, lost 87% of its value. So it was devastating to the NASDAQ. Also, it was pretty devastating for the S&P, but the recovery in the B wave was dynamic. And this is the one where the Dow Jones went up to a new all-time high by itself. The S&P got close, but did not actually move to a new all-time high before collapsing in 2008, 2009, and bottoming then again in March of 2009 and primary 4. We started to come back up, and we're going now up in primary wave 5. And then what I had labeled as, this would have been previously cycle 4, and within cycle 5, these would have been primary degree. I had placed a primary third wave at the top just prior to the COVID pandemic hitting, driving the market quickly lower. At about 6 weeks, we lost 38.382%, about 38% of value in the S&P, and I had labeled that as a primary. I've now reverted, and I'm back down to, it's still a fourth wave, but it's intermediate degree. So there's my adjustment. So instead of really moving up in these larger degrees, there's still large moves, and the size of the moves haven't changed, but I've changed the degree. So again, 1, 2, 3, 4, and then intermediate wave 5, primary wave 5, cycle degree wave 3. So bringing this down now, and we'll go to this 5. So bringing it down off of this cycle degree, it brings us into a cycle degree fourth wave versus a super cycle degree fourth wave. So the cycle degree fourth wave will be consistent of a primary degree A, B, C. So instead of looking for an ABC on a primary degree to put in a cycle wave A, and then we get a cycle wave B, and then we get a cycle wave C, the fact that we're back up here and this is all turning into a flat, basically, it just really presents us with a much different picture on what this C wave should begin to look like. And to put in a cycle wave A, I'm looking for much more, the best way I could put it is market destruction, price destruction, bailing out of things, that the economic picture is not as rosy, is not as having hope. And so what we've now witnessed as this has been progressing, there's still some factors in terms of the economy, in terms of inflation, in terms of a lot of other areas that are going to affect our markets. And again, right in here is where I'm going to add one that is getting press, that gets mentioned, but we're not really looking at it the way that I think that it could occur, and puts us back on par to back in 2008, 2009, was the last time that we had really problems in terms of interest rates and in terms of mortgages. But then they were for retail, for us. There were mortgages on homes, and that's what really kicked it off. And now we're putting in that same type of a move. We're having an A wave, we're in a B wave, and we're still looking for a devastating C wave to hit us. And everybody's now wondering, it's like, well, no, we've got all this positive things because the Fed's going to start cutting, because et cetera, et cetera, et cetera. It's like, folks, the Fed could cut rates, and it's not going to produce, possibly not going to produce the bullish picture you think it's going to produce. What the narrative is talking about. Don't forget, we dropped down in the great financial collapse. They cut rates. Rates still went to zero. You have to understand, it's like from that point, from 2009 up, we went down and we dropped to 0% interest. That's what the Fed cut to. They instituted a policy, zero interest rate policy, called ZIRP. They bailed out not only the economy, but the corporate world by offering them all 0% interest rates. Yep, they had to pay them back, et cetera, but still. Now, what produced that? Well, it was just a lot of mishandling of mortgages, mishandling of banking. Now, we saw a taste of that. We got a little bit of that when we saw what happened to Silicon Valley Bank. We saw what happened to First Republic. We saw that happen to several other banks, Key, that just went under. They were taken over. But they kind of got bailed out. Is there more out there waiting? Well, let me tell you where I feel that we have a problem that has been brewing that may or may not, just, the whole process has not really come to fruition in total. So I live in the city of San Francisco. Now, besides what people want to talk about, San Francisco's all these problems, we've got, all the political stuff that they want to talk about. The main thing that I want us to discuss right now is the commercial real estate in San Francisco. Now, we went through a boom where, there was such expansion in high tech. There was super expansion within biopharmaceuticals. There was expansion within just technology. There continues to be expansions in technology via artificial intelligence, a whole new sector that promises to provide tremendous market growth. But what has happening in between is we had, the difficulty within the economy. The city and county of San Francisco truly has not recovered, as many cities haven't, from the problems that were created from the pandemic, when we basically had this work from home policy. So a lot of high tech, being that they're more progressive, whatever we want to term it, haven't really rescinded those you can stay home and work policies. So the remote workers still are not going back to an office. They're still working from their homes. So the vacancy factor in the commercial vacancy factor in San Francisco is, I think, 32 or pushing towards 34%. We're seeing buildings, high-tech buildings, beautiful new buildings, all, with all of the all of the new technology that goes into construction. That a lot of these buildings were sold for example, the latest one I found was sold for $166 million. Not a big skyscraper. I think it was like 30 floors or something of that nature. It's now back on the market and been reported as being sold for 50% less than what it was last time it sold. So the buyer of that building, and I believe it was in 2020, maybe a little bit prior. So we've seen in that 3-year period where the real estate was so overpriced, and that they just, first of all, the offices are empty. So they're not able to service these loans. So corporations, investors are walking away from the loans. We've seen hotels where they just walked away, gave the loan back to the lender. Nope, can't do it. So we're out. And they're getting, it's basically instead of giving it back, instead of getting foreclosed, they give it back. So there's that problem is growing. And we're seeing more where the loans that are the sales and the new owners are picking up some good bargains. Now, if that continues, still someone's getting stuck with the loss of $80 million. So my point is, it's like, how is that all going to factor out? How is that all going to be revealed? How is that all going to be put in to where it needs to be put in? Is it going to come on the corporate level? Big loan loss. Is that going to come from a lending? So it's going to be on the bank level. Somewhere, all of this has got to filter through. So I think that the next larger problem, and it's not just a San Francisco problem. It's not just a California problem. I think there's many cities across our country that are seeing the same thing, where a lot of the loans can no longer be serviced because the corporations just aren't getting the revenue that they're able to service that loan at that rate, at that amount, etc. So there's two factors here. Either they're going to sell or they have to refinance. Now that's going to create another problem because, again, somewhere along the line, someone has to take the loss. If you need to refinance the loan, you're looking for a lower rate, which doesn't exist yet, right? Because we just had all the interest rates rise. So that's adding additional pressure. So that's why they're walking away from the loan. They're giving it back and saying we no longer. So those buildings then become the property of the lender, and they're going to have to turn it and sell it. And they're not getting, it's like a fire sale, right? They're getting a lot less for this. So somewhere, someone's taking the hit. So unfortunately, or whatever, many of the commercial loans are not really being capped by JP Morgan, JP Morgan Chase or Bank of America or the big banks. It's the smaller regional banks that take those on. And it's a consortium. It's this group, that group, and that group, and they're all providing the financing. Now suddenly they're out, and there's somebody's left holding the bag. Or how is all of this going to work out? So the bottom line point is, as this is a brewing problem that it gets some press, and I'm putting quotes around that, and it is some talk, but it's not being factored in. And I don't hear the Fed mentioning anything of a commercial level. I don't even hear our Treasury talking anything about our what's going on the commercial banking level on these loans that are coming due that need to be refinanced. And I think the reasons are obvious because, number one, it could spook the market. Number two, it could just really start a nosedive that we don't want to see. Number three, I think is going to come out. And here's why. If I'm looking at this market, we're done with primary A. We're getting very, very close to being done with primary wave B. That leaves us with a primary C wave down. Now, here we sit and they're all talking. We're just going to continue to go up. And we may, because I had felt that this would come to a conclusion and we'd start on primary C wave down prior to the start of 2024. I now am revising that and saying that, well, I still think we got more to go to the upside, and that may roll us out into 2024 and roll us out into the month of January at some point. In fact, I can't really say it's going to happen in January or is it going to happen in February or is it going to go really out into March? I don't think it'll get that far because the wave pattern inside all of this, which I'm going to go over in a second, really doesn't lend itself to just climb and climb and climb and climb and climb. I mean, we can do more. And we actually can have. So I'm going to start to build our picture as to levels of where all of this can complete. Now, again, basis the cash market, we've yet to move to a new all-time high above what was put in on January the 3rd, 2022. So the first day of 2022, first trading day, the S&P topped and it reached an all-time high at 4,818.62. Now, we are getting close, like I just said, but we still have not, on a cash basis, broken back above 4,800. So if I had to go and figure, okay, will we? Because the futures market basically is saying we're already there. We've already broken above 4,800. We've already broken above 4,821, I think it was the high so far. So we've already put in a new all-time high via the futures market. If the cash is going to follow in that, what can we possibly do? Well, the first thing I'm going to look at is what if it's just an irregular, so an irregular B wave. And this is something that Elliott himself noticed and talked about and described and gave us parameters for what occurs when that happens. One thing that Elliott did talk about a lot, and this is my interpretation, others may have a different interpretation. Elliott talked about when you get to a major high, it is most often corrected not once, but twice. So here's the first correction. Okay, that's the A wave. Well, now we're in the B wave. What if the B wave makes a new high? It then becomes an irregular B wave, which Elliott talked about. B wave, what follows is a C wave, and that C wave will be stronger than the A wave and drop itself down. Therefore, this gets corrected twice. First time, we get the rally, and then there's the second time. That high gets corrected twice. So, on that basis, I want to, I got it set up. Let's go and take a look. What if we were to go into an irregular? Hasn't been done yet. So what really believe to, yeah, we're going to take out all of that because we don't need any of it, because really what we're looking at is these. We're looking at 1.236 and 1.382. There's the 100% for 48.18. We're close, but we have not gotten above that yet. I would suspect that maybe in this fourth wave, maybe, and I'll get there in a minute, it might break it. But, and if it does, we're going to have levels up into this here. But if it's going to be a true to form on a weekly chart, an irregular B wave, we're looking for it to move 51.31 to 53.25. Those are the fib levels. That doesn't suggest that's where the market is going, because to tell you the truth, you can only guesstimate. You can't say with some clarity, that's for sure where we're going to go. Now, if it's an irregular, now I'm going to start to bring this down. We're going to start to look at these internals. So again, primary wave A, ABC. Primary wave B will be an ABC. More than likely, it will go to a new all-time high, about 48.18, before this is all done. More than likely. Now, let's start to bring this down. Let's take it down and look at the 2-hour chart. The 2-hour chart, there we are. There's primary wave A. We have an A, we have a B, and now we're in the C wave. Now, this whole C wave has just presented its big challenges. Why? Because we had this huge decline right here. And now we have to accept, because of this momentous rally that we've been in since October of 2023, right? That's October of 2022. We bought them again in October of 2023. There was tons of talk, remains tons of talk as to what produced all of that. First of all, we had the PPI. First, we had the AI explosion. Then we have interest rates are done. They're done going up. Inflation's under control. Blah 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 blah. So we see a ton of money come storming back into the market. And we had not once but twice where we had this breadth thrust indicator trigger. Now, speaking of that, what is the reason this thing has 100% accuracy and continues to? The way that it is written, the way that the observations were made, state very clearly that between 6 and 12 months after it has been triggered, the market most often will gain 15 to 25%. Well, the first time it was triggered was in May. 6 months from May puts us in November. Well, that's when it was triggered again. But even there, well, from where it was triggered to how high we have gotten in the future, and you could say in the cash, have we gone up 15%? The answer is yes. So again, 100% accurate. Now, we've had this on the 20th of December, this last week. We had this sudden reversal in the market and it dropped. But it was a 90% down day. And this information, by the way, I'm going to give credit where credit is due. This came to me from my friend, my good friend, my mentor, as far as Elliott, Dan Ascani. And he does a lot of work and he does a lot of work in terms of statistics. So we've had 90% up days in terms of like the breadth thrust. That was a 90% down day. Now, usually when you're going to get that much of a sell-off, that strength of a sell-off like we did in an hour and a half, which it was, it really gives a signal the high, the top may be in. Here's the kicker. The next day, although it wasn't as large, was a 90% up day. So it's like, okay, what are we doing here? What's the market really doing? Hence, you're seeing where we're all sitting going like, what is going on? Now, I think there's a lot of reasons of what we're seeing. And I think much of it has to do with the amount of capital that has been made available over this huge rally off of 0% interest, off of a lot of excess capital being made available. We've seen a lot of wage inflation where people are making a lot more money. So again, et cetera, put it all together. And it has been written and spoken about that last I heard it was $6 trillion. So I had heard like 5.2 trillion. That grew, was sitting looking for a home. They were waiting for a bottom. They were waiting to get the market. Well, that announcement, they started gap, 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 gap all the way. So money has been pouring back in. This particular day, that was the thrust. No, it was back here. No, it was back here. Back in November. That was the breadth thrust indicator getting triggered. So huge volume. This was a big volume day. That was, I believe, CP. That was Fed decision day for December. Then we get this. So we have, there's just so much going on. But I personally do not think that the top is in yet. So what do we got going on? Minor 1, 2, 3, 4. We're inside an intermediate C wave rally. What's going to be consisting of it? 5 waves of minor degree, which we have 1, 2, 3, and 4 were in minor 5. Liked this. I never liked calling it a minor 4, but I really don't have much choice outside of this. Because it doesn't make sense to say, you know, A, B, and this is 1, 2, 3, 4, 5, C, A, B, C, X. And then we're doing another A, B, C up because we're running out of steam. We're running out of purpose to just continue. Because this would mean, now again, what it would suggest, if I go back to that count and this turns into an intermediate X wave, what it's suggesting is intermediate A, intermediate B, which doesn't fit because of the degree, right? Here's intermediate A, here's intermediate B. That I'm going to put it here, doesn't fit. Minor or minute degree, it does fit. So minor 4, we're in minor 5, minute 1, 2, 3, and 4 done. That's the daily chart. By the way, all of the moving averages, right? There's the 8, there's the 20, there's the 50, these are simple, cross the 100 beautifully, right? Then here's the 200. So in alignment to continue higher on the daily. And bring that down. Let's bring it all the way down. I got to go back over to my 4-hour chart so we can see. All right, wave 4. Putting it up this way. So there's 4. 1, 2, 3 extending beautifully. 4. If I really got pushed and had to change what this all is, there's a possibility that 3 would have to come down to here, actually, and 4 would be here, and this would be a 5. Now, that would suggest that this huge decline that we got on last Wednesday afternoon, I believe it was the kickoff, was the signal. The top is in. And if that's the case, I got to go back out and go like, okay, we're not moving to a new high, but it is a B wave. B wave can go almost and you know, just without. And let me just show you. We move it back out, and what are we looking at? A, B, flat. You don't get much flatter than that. Get up that high and finish, and then just start to nosedive in a C wave. And then it's a primary A, primary B, primary C wave down. And this is what I'm telling you, that these all fit. But we need, and is there a catalyst? Yeah, there's enough out there, in all honesty. There's enough out there to kick it into gear. But I'm continuing to look at, we got the year end. Okay, was that just a one-off thing? We heard that it was blamed on the fact that zero DTE options, there were some very, very large put positions that were put on, and dealers got, needed to hedge, and then sold those puts to the buyer. Then they needed to sell the underlying, which was the SPX, be a basket after basket of stock. So, and there was 3 very huge positions put on in the 4750, 4755, and 4600, I believe, put options that expired last Wednesday. So we had volatility in there. We had a lot of things going on. We had a lot of plays happening. And so as this starts to sell off and you're short that put, your gamma is exploding in your face. You're just getting longer and longer and longer, and the market is nosediving quicker than you can say, ouch. So produces a bad situation. Now, if we can, this is very inconclusive. In fact, it's totally inconclusive that even this 4th wave is done. So if we're going to keep this count, that we still have 1, 2, 3. We're in a 4. We still have a fifth wave up. Now let's start building that case. All right, let me go back out to this daily chart. So here we have, I'm going to start putting it up. Hold on, let me get my right tool, which is we do that extension. So let's see if indeed we still have upside. What does this tell us? Well, we've already done pretty much all of it. So I'm just going to go in here, going to edit the properties. I'm going to take that out, that out, that out, and that out. And I'm going to leave 368 and 4.236. Those are the next two levels up. For minor wave 5 as it relates to minor wave 1. We've already seen 2.618, done, exceeded. So what's next? 3.618, 4.236. All right, so now, if this completed the fourth wave, a minute degree, what can we look at in a wave 5? Well, again, we do the same thing. Let me just bring this down off my daily. Go to my 4-hour chart, open it up a little bit, and now much cleaner. I can catch it cleanly. And I'll put this over here to this low. So here we have, now we got some different numbers, right? And so we have our next level up. Okay, so here we have minute wave 5 as it relates to minute wave 1. 618, 4875. Equality, which is usually number 1, 4985. Now, mind you, if you remember, I got my irregulars sitting out here, and now you start to see it can cluster around them, even in that minute fifth wave. Minute wave 5. I mean, it's just, can you tell me for certain of next week that they're all going to hate it or love it? Or they just kind of futz around and then we start the new year and they still are moving money in? No, I don't think anybody can really say they are not going to do that. So these levels are for minute wave 5. So, and these are for minor wave 5. Minor wave 5 can get us dang close to that first level of an irregular B wave. So anything over 4818 pushes this in a regular B wave. Whether it finishes here, 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 or here, it still will be an irregular B wave. And we'll still be able to calculate down for a C. So again, I'm building up levels to where this market can get to based on the fibs for each degree. So now I'm into the minute degree, and that's as far as I actually can go until I start to see. Now going back down to that hourly chart where it's not totally clear. As far as this got close, but didn't do it, didn't go over 77, 78. It got as high as 72, 73. So it could be a B, A of 4, B of 4, C of 4, right? And I can go into, you can do fibs for what it could look like. A, B, C. I can put it in, but the chart gets very, very tacky, and that's not, this is the cash. I'm going to do it anyway. Go down to here, and go back up to here. So where could wave 4 come in? 46, 43. Less than 100 from here. What if they decide, boom, we're down. We're going down and out for the count come Monday or Tuesday or Wednesday of next week. Or we actually go down into year end and then go pick it up again in the new year. So again, these are the scenarios. This is my process. I'm giving you the possibilities of what this market can do and still turn and go higher. So if wave 4 is complete, then we're looking for this wave to just pick it up, right? 1, 2, 3, a little bit of a 4, but came down a little bit too far, but we'll probably allow it. And then we get a 5 that takes us above there, and it's wave 1 of 5. Then we get another correction and we run. That's one scenario. Second scenario is that we're not done. This is wave A of 4, wave B of 4. We're going to come down in a wave C of 4. And we turn and we run again. What is our support? First one is 100%, 46.92. That puts in a new low below this one. So it could be ABC, put in a flat. ABC basically flat. And then we run. Or it comes all the way down to 1.618, which is the next level down, and we run. Since it's not irregular, 100% is more in tune. So we got 46.97 to 46.92. Outside, if it becomes serious, 46.43. For the balance, it's right in here. And it's a nice ABC flat, and we run. So those are the two scenarios that really we need to look at. If this wave 4 is not done, and we got to move this out to here, we'll recalculate. Any move below 46.97 or that low, we recalculate, even at 92, 5 points is 5 points. It's going to pull this down a little bit, not by a lot, but pulls it down a little bit. But so in any case, I believe that we still have additional upside, and the potential for that upside is pretty strong in terms of what the market is going to be capable of. So we have this fourth wave, the minute fifth wave there. We have the minor fifth wave, all of which have pretty strong upside potential. At least above to new highs and above 4,900. I think the potential is strong. If the rally is going to keep going, potential is very strong to get ourselves above 4,900, very close to 5,000. And that, my friends, is the SPX. Let's go over and look at the ES, because now I'm not going to have to go through all the background stuff. Now we can just talk levels and fill in the blanks here. Now, what I got here is our C wave, which I didn't necessarily add on the other side. Wave C would be equal to wave A at 51.87. All right, so that's on the intermediate degree, which I didn't actually put in the SPX, but we'll keep it here in the ES, in the futures. Same deal we got coming up. Intermediate C wave. And so what we got is, within that intermediate C wave, there'll be 5 waves of minor degree. I'm going to bring this down. And that was the 4-hour chart. Oh, hold on. Let me go open that up. Oh, wow. Okay, let me not do that. Do need that 4-hour chart. I just got to keep it a little bit tighter. Yeah, good. So there's the 4. So then we have minor 1, minor 2, minute 1, minute 2, sub up to a 3. You begin to question that was a pretty strong down day again. So I could leave it where we're in a minute 5 up, but that's supposedly just going to complete the minor third. So it's not as consistent as the SPX is in that same position. Minor 4, 1, 2, 3. So because what I've done outside of this, and I could do here, I suppose, to change this around, move the A up to here, put the B over to there. But I'm leaving this as my preferred. So in that case, what I would do here in the S&P and the futures market, put it back. The A, the B, 1, 2, 3, 4. But you see here, it really dug in to all of this, which is why I switched it. Now, it becomes very interesting that I'm going to have such a difference between the same market. One being a futures basis, the other being the cash basis. So I'm not sure. So I'm left out kind of as to what all of this ends up being. Because it can't be a 4. Because this has to be the A and that's the B. and this is 1, and this is 2, it's overlapping. And not just overlapping, it really overlaps. It really overlaps. It really overlaps. So it becomes very difficult to leave that label as a 4. I put it B. We have 1, 2. So how do I rectify all of that? Again, on my 4-hour chart, I bring it back in and I put 1, 2. This 3 goes here, that 4 goes here, and the 5, and that's the 3. So that part I can do. And then this makes this. So in other words, I can get, let me just put this, I'm going to show you. I wanted to do it so that we all can see exactly what I'm talking about. A lot of people aren't going to like it, but it may be the ticket that we have. Otherwise, what we're looking at is that this fifth wave, this minor third wave, is still in action, and we still have a minor 4 and a minor 5. This is what tossed it. So again, I'm allowing for a continuation, but if you'll see when I do this and then put the fifth wave here, the minor 3 here, suddenly that 90% down day is okay because it was big, but it was a minor degree top. Third. So we're in a minor fourth wave versus a minute fourth wave, at least in the future. That's to me. Now, is this fourth wave done? Future's kind of saying no, right? So now let's start to build out our picture, and we're just going to take a look here. Okay, so we had that C wave, 51. Okay, now we're looking for minor 4. If that's it there, and I'm going to put this out to see what we come up with. If this is the fourth, well, 4922, 100% is 5,033. Where 5 equals 1, 5,033. 1.618, 52. We're above. Now we got up to that C wave level. So you start to see how your fibs start to fill in. And now we've built clusters. Now, what else can I add to this? Basically, we want to look at what the third wave probably could have come in there. I'm going to add one more, and I'll likely remove it because third wave is over. But we're looking to see, is that a mess? Let me get out of it, start it over again. Okay, from here to here. Wave 2 was so small. So you see 1.618, 48.76. Came above the 100%. Now, let me just kind of throw another number out there and see. A little bit above, so it came in just above 1.382, 1.618. It works. It fits. To put that minor 3 there. And I'm going to remove that, all of that. So if we're working with this being minor 3, it does fit. We're looking for minor 4. I am going to leave that there, but that's considering that this is the fourth wave. Now, if I need to take that down, I'm going to go one more. I'm going to do that same exercise. What is our potential? 100%, 47.34. Nice and flat. We got pretty close, right? This is 31. We got as high as 21, 22. That's close. That's pretty flat. So maybe we drop back to 47.34. We put a 4 right there. Doesn't really change those upside numbers. A little bit different, not by much. And then we run. What's the other extent? It could drop all the way to 46.80, but we got the 100 in between. So 47.07 becomes some pretty good support level if it breaks 34 coming off. And then minor 4 would be done. All right, nice, either a little bit extra. So it all works. And the 4 comes here and we still launch. And we make our adjustments if necessary. So overall, I do believe we still have upside. But interim between now and next Friday, which is year end, we may see some profit taking. We may see some position cleaning. We might see some things getting pushed and other things being sold. And how they want to take things into 2024. Do they want to close the books for 2023 by taking some profit and booking it? And then reinstituting new positions come the following Tuesday? Possibly. Very, very possibly on January the 2nd. Instead of going down, we go up. And then we go to new all-time highs again. Finish up this primary B wave. And we begin to go down. So it actually kind of can work out that maybe the first couple of weeks, maybe the first month, the month of January, is to the upside. But we will eventually keel over, and all the other things I'm talking about may come into fruition or start to lend or start to change that picture, and we start to nosedive. Now, I'm not saying we're nosediving. I'm not saying we're going to crash. I'm saying we're going to correct. And because it's a cycle degree, right? So it's a primary degree decline to finish a cycle degree correction. It could be pretty heavy. No one was really looking for that pandemic move that happened. It just came out of the blue, right? We had a pandemic and there was good reason, et cetera. But even in lieu of all of that, what took place was the market going like, okay, we're freaking out. There may be something that'll happen again that the market say, okay, we're just going to freak out. And it's short term in nature, a month, 2 months, finds a low and we turn and rally. For all I know, folks, it's like, remember I talked about this before, what's the possibility that we actually go down and then rally again, but in the second quarter of 2024. So we go down, we lose, what if we come off 38%, right? Did I not? On the other market I did. If I go and I take a look here, let's just take a look here. If we're really thinking, okay, what, I got to go out to my weekly, my monthly. Because I need that, the S&P, I can't find it. I don't have it because I don't have enough data. I have to go on the basis of other calculations. So what I can do is I can, once I get it there, I can put in a C wave and we can get it this way by looking at wherever this B wave, A, B, C. But if we're just going on the fact that it's going to be basically flat, right? An A, a B, this, we already are above it. 4808 was the high. So we're getting a little bit irregular, right? Depending on how high we get, then we're looking at going like here to here to here, but looking for 1.618 down. So it truly leads us back to 3,500 down to approximately, we could get as low as 29. And yes, people go, oh, it's a crash. No, it's not. No, it's not. Go over and reference his previous crashes. The great financial collapse was not necessarily even a crash. The last crash that we had on a large cycle or a larger degree was 1929. And it was the secondary drop that actually produced the damage. So, okay, so here we are again, where we're in that secondary drop. So yeah, it could knock the breath out of the market, but I'm not looking for it to drop down to this low. I would expect it to be more related to wave A, which that low is 3,500. So we're looking at more like that. All right, so I really need to move on because this is like going to be super long. And in fact, what I think I'm going to do is I'm going to finish this one, label it, post it as the SPX, and I'm going to do another one. So these are kind of year end, and I'm going to do another one for the NASDAQ. So wrapping up the S&P and just putting it in because, again, there's no Globex on Sunday. So the next Globex session will start on Christmas evening. That what I think we might be dealing with next week is coin toss. But it looks like we may have additional downside to begin the week to finish minor wave 4 in the futures market, minor wave 4, and then we rally. So that's how I'm going to leave that. And once again, please have a very safe, have a very, very Merry Christmas. Enjoy family, enjoy whatever it is that you're going to be doing. And the next update will be on Tuesday, December the 26th.